Dividend versus growth investing. Which is going to make you rich faster? That is the million-dollar question. Today we are going to look at the pros and cons of dividend and growth investing, and also take a look at two example ETF portfolios, one focused on dividends and one focused on growth, and see exactly which one of those would have made you the most money. Let's go ahead and get into the video. If you're new here, my name is Cade and I talk about investing in personal finance on this channel, so if you're into that, go ahead and hit the subscribe button, as I am fairly new at this and it would be greatly appreciated. But to set the stage, I wanted to show this chart here in a second that shows dividends versus growth to really give a rundown of the two different strategies. Getting into the dividend side of things a little bit, historically since 1926, dividends have accounted for around 31% of the S&P 500's overall return. Typically, dividend investors are those who are seeking cash flow or some type of income. Usually, these dividend paying companies are more your stable companies and those that have been around for a long time. So think of your Johnson & Johnson, your Coca-Colas, your utilities companies, your energy companies, those that have been around for ages and likely don't have as much growth potential, and so they are returning their profits to their shareholders via dividends. Typically, the risk level with these is also a little bit lower and you won't see as much volatility with dividend companies. But also, like I previously mentioned, a lot of times the overall return and growth is not quite as strong since these are much more established and stable in their respective sectors. And hopping over to give a quick summary on the growth side of things, historically, capital appreciation or growth has accounted for around 69% of the S&P 500's total return since 1926. And looking at the chart again, these are typically your companies that are growing faster and have seen much higher capital appreciation. Usually these companies do not have a dividend because they are reinvesting the profits back into their business to help them grow their revenue, grow their customer base, and grow their overall influence in their sector. Some examples of growth companies are your Apple, your Amazon, Tesla. These have seen great growth over the last few years. One thing about these type of companies, though, is that oftentimes they are more volatile, and so that can be associated with them being more risky. Typically, growth investments are more ideal for your longer-term investors, sometimes even your younger investors, those who are seeking a high capital appreciation over the long term. So now that we gave a quick high level of growth versus dividend investing, I want to go ahead and get into two mock portfolios, dividend ETFs versus growth ETFs. I will say for this example, I chose 3 dividend ETFs and 3 growth ETFs. And before the keyboard warriors come out and say, okay, these have so much overlap, you don't know what you're talking about, I did this on purpose because I didn't want to pick one particular dividend fund or one particular growth fund and then get accused of cherry picking, that specific fund and making my example. So I chose a few popular dividend ETFs, a few popular growth ETFs, and I put them into Portfolio Visualizer, which is a program that you can use yourself. You can go back and back test any portfolio that you want. So if there's something you don't like about this example portfolio, you can go back, change the factors on it, change the funds in it, and you can run a back test for yourself as well. That said, let's go ahead and get into the first fund, which we're going to look at, which is the dividend fund. The first ETF in the dividend portfolio, I'm going to read off my phone for these so I can rattle them off real quick, is VYM. Inception date 2006, $65 billion in assets under management, 0.06 expense ratio, gotta love Vanguard for that, 2.45% dividend yield, and an 8.94% average return. Coming in at number 2 in the dividend fund is SCHD. Inception date 2011, $71 billion under management, 0.06 expense ratio, 3.86% dividend yield, and a 12% average annual return. And then finally, the third dividend ETF coming in the dividend fund is DGRO. 2014 inception date, $34 billion under management, 2.16% dividend yield, and 11.8% average annual return. Plugging these in and running the back test is actually a little bit surprising, as this dividend ETF fund actually underperformed the S&P 500 over the last 10 years. Your average annual return was 11.9%, and then over the last 10 years, your 10K would have turned into around $30,000. It's important to note that these returns do account for your dividends being reinvested, but they do not account for you paying taxes on those dividends. So essentially what this calculator is doing is assuming that you have this fund inside of an account like a Roth IRA where you're not taxing those distributions and they can be fully reinvested. Another thing is that if you are truly seeking high dividend paying ETFs, there's a couple other ones out there like QQQI or SPYI that use a covered call or option strategy to help supplement that dividend. I didn't put one of those in here. Be careful with those funds with a very high yield. Oftentimes they can be too good to be true, which is why for this example I used some stable funds that are very popular in the dividend space. So keep that 11.9% average annual return in mind. We're going to go ahead and jump into the growth focused portfolio and see how the numbers on this one come out. Got my phone back up for the growth portfolio. We are going to do 3 ETFs as well. The first is VUG, inception date 2004, 12.1% average annual return, 0.04% expense ratio, and $195 billion under management. Coming in at number 2 is QQQM. This is actually identical to the very popular ETF QQQ. The only thing different with QQQM is that the expense ratio is just a hair cheaper. So I went ahead and put the inception date as 1999, 10.4% average annual return, 0.15% expense ratio, and $63 billion under management for QQQM. Coming in number 3 is Vanguard's Tech ETF VGT. So that has an average annual return of 14.2% over the last 10 years, 0.09% expense ratio, and $110 billion under management. The returns of this fund are very different from the dividend portfolio. As you can see, this portfolio actually outperformed the S&P 500 over the last 10 years with an annual return of around 20%. And over the last 10 years, your 10K would have grown to $63,000. Once again, I included 3 of your most popular growth funds that are out there right now. Some people might want to have some Bitcoin ETF exposure. Some people might want to have some international ETF exposure. It's really up to the investor on what they want for their portfolio and what they think is going to do the best over the coming decades. So now that we've seen both portfolios and we take a look at the head-to-head, it is clear that growth is the winner over the last 10 years as your final portfolio value is from 10K to 63K compared to the dividend ETF that was 10K to around 30K. And yes, 10 years is a short time frame and there has been a lot of growth in the last 10 years. So some of these results are likely skewed in the growth ETF portfolio's favor. But I will say there's a lot of examples out there that you can go read about as well too that have a longer time frame. But historically, over the long run, your growth is going to outperform a dividend-focused portfolio. That is just how the cards usually fall historically. With dividends, you often have to worry about taxes if you're not in a tax advantage account. And with growth, you really don't have to worry about those taxes eating away at your returns until you cash out for your total portfolio value. We didn't touch on it earlier, but it's also important to note the volatility of each of these portfolios. On the growth ETF portfolio, it saw a max drawdown of 32%, and on the dividend ETF portfolio, it only saw a max drawdown of 22% over this 10-year period. This is definitely something to consider if you are farther along in your investing journey or closer to retirement and you don't want to see as much volatility. That is another reason that dividends paying companies or ETFs are often more preferred, is that they are less risky, like we talked about earlier, and less volatile. Growth ETFs, growth stocks, you're going to see a lot more up and down. So that's just something to keep in mind when choosing between these two strategies. So dividends or growth, which should you pick? And as with most things with investing, it depends. For younger investors, personally, like myself, I believe that growth investing is the most beneficial over the long run. Since we have such a long time horizon, compounding can really work wonders, and that capital appreciation can do some great things to your portfolio. If you are closer to retirement, or maybe you just want to have cash flow, then dividend stocks, dividend ETFs are likely the way to go. Provide that consistent cash flow. That is always nice. Like I mentioned, over the last 10 years, the market has favored a growth portfolio, but in times when the market is flat, dividends often get a lot more praise because growth stocks aren't growing, but dividend investors are still getting paid. For that reason, the most logical approach for most people is to do a blended style of dividend and growth investing. For someone like myself, I would likely lean more to the 70% growth and maybe 30% dividends. If you're someone closer to retirement, you could lean more 70% dividends, 30% growth. You can adjust that however you see fit and whatever better fits your situation, in all honesty. But over the long run, the most important thing to remember is that your growth portfolio is likely going to outperform your dividend portfolio, but it is going to provide the cash flow. That's the video though. Thank you for watching. I hope you learned something. Like I mentioned before, hit the subscribe button and drop a like. Even put a comment down there. That would be great. It would really help me out since I'm a new channel and I would really appreciate it. Thank you for watching. I'll see you in the next video.